The market is in love with safety stocks right now, but safe stocks may not be that safe after all. I'm Jack Otter, editor of Barron's.com. I'm here with Andrew Wellington, who's the Chief Investment Officer at Lyrical Asset Management. Thanks so much for being here, Andrew. I want to get your big picture view of the stock market and then maybe talk about where you're finding opportunity right now. Let's start with, what do you see when you survey the stock landscape?
Yeah, so we're pure bottom-up investors, but still, when we look at the overall stock market, what we see is a market that on the surface appears to be a bit overvalued. It's trading a bit above its historical multiples. And yet when we go and look at the market from the bottom up, what we really see is there's not really one market out there, but actually two. There's one part of the market which is very, very expensive today. And that's where those safe stocks you talked about, those companies that are perceived to be really safe, plus companies that are paying high dividend yields are very expensive today as people are looking for bond substitutes.
Utilities, that sort of thing?
Utilities, REITs. And then lastly, you see also in the expensive world some of these high-flying growth stocks, the FANGs, Facebook, Amazon, Netflix. And then the other part of the market is just about everything else. And they actually look really, really cheap today and offer some really exciting valuations.
I want to ask you what those names are, but just briefly, you said the only time you've seen a spread this wide between cheap and expensive was the internet bubble. Now, in my view from 16 years ago, that didn't work out so well, but you pointed out that actually the cheap stocks did okay.
Yeah, and the internet bubble, to be clear, was way worse and much bigger overvaluation and bigger spread than it is today. But after the internet bubble, this is the biggest spread we've seen between expensive and cheap. And you'd think that, okay, when the expensive stocks eventually collapse, that's going to drag down the rest of the market with it. And that makes a lot of sense. It's just not what actually happened. And I don't know what's going to happen the next time, but back in the internet bubble, not only did the cheap stocks not go down, they actually went up, and up a lot.
So let's start with a very untechy, very boring business that you've recently found some opportunity in, and that's Whirlpool.
Yeah, we like to pride ourselves on making exciting returns out of boring businesses. And Whirlpool is the last stock that we added to the portfolio. They're the global leader in appliances for homes, big North American business, but they actually are a global business operating on all 4 continents.
And what sort of valuation?
Whirlpool today is about 10 times earnings.
Wow.
The company has seen its earnings recover dramatically off the down slope of the housing bubble. And I think people think, oh, this is a really cyclical business. And it actually isn't. It did suffer a lot during the housing boom, but that's the only time it ever did. Most appliance sales are actually driven by replacement, not new home construction. It's just that in the housing bubble, new home construction was so off the charts that it overtook the rest of the business, which is far more stable.
It's amazing how long that hangover has lasted when construction and other businesses that did so well in the bubble and are still sort of shaking off the blues. Let's move on to Lincoln National. This is another opportunity you found.
Yeah, perhaps the only stock that could be more boring than Whirlpool is a national leader in life insurance sales and annuities. Lincoln National, well, Whirlpool sounds cheap at 10 times earnings. Lincoln National is around 6. So this is a very solid, we think pretty safe business that we're able to buy at an extraordinarily low valuation.
I assume it's a victim of low interest rates?
I think the valuation is a victim of low interest rates. The earnings, not so much. See, Lincoln doesn't just sit around and say, oh, interest rates are low, we're just going to make less money on our investment portfolio. They have a lot of levers that they can pull. So as we've moved over the last several years into this low interest rate environment, they've shifted their product mix. They've changed their pricing. And actually, their earnings have continued to grow in spite of this low interest rate environment because the business is so adaptable and flexible.
One more, it turns out you actually do have a tech stock in your portfolio. Can you tell us about that?
We actually have, tech is one of the biggest areas that we're invested in. We tend to stick to the older, more boring side of tech than the cutting edge, new thing kind of tech. But we bought a company, Microsemi. You think of tech companies as being new. Microsemi is probably 40, 50 years old. It started out in the aerospace and defense industry, making microchips for missiles and fighter jets and things like that. And it too, in spite of its very attractive growth rate, is also at about 10 times earnings.
Thanks very much, Andrew.
Thank you.